Welcome to No Flipping Excuses with Jason Lucchesi. Jason Lucchesi was the guy voted least likely to succeed by his high school peers. Today, Jason's a real estate flipping ninja Jedi Knight assassin who's taken his drive, street smarts, and never give up attitude and converted them into a real estate flipping business and freedom-based lifestyle. After years of being chained to a cubicle in the mortgage business, watching his coworkers go bust, customers go bankrupt, and his hairline go bye-bye, Jason decided to make a change and blaze his trail to the flipping promised land. Each episode, Jason shares real-life real estate case studies, tips on how to find, finance, and flip deals, and mindset tactics he uses every day as a real estate investor, mentor, and leader so you can free yourself from the shackles of corporate America, fire your boss, and live the life you've always dreamed of, right flipping now. Here to share the truth about flipping houses, finding sellers, delivering buyers, real estate investing without the reality show hype, and all-around general business badassery, your host, Krav Maga enthusiast, husband, and father of three, Jason Lucchesi.
Hey there, what's up? It's Jason Lucchesi, and welcome to the No Flipping Excuses show. I'm extremely excited that you're here with us right now. It's 2018. We've got a lot of amazing things that we're going to be sharing with you over the course of this year, and this is a great episode that we're going to be talking about. It's really revolving around how we can help you with getting deals funded for you and also building up your long-term wealth. But before I get too ahead of myself here, I want to just remind you, make sure, if this is your first time listening to this is an actual amazing show that you're getting yourself into, especially when it comes to deal funding and building up long-term wealth. Enjoy this whole entire show until the end, and then if you could do us a favor, subscribe to us on iTunes and leave us a 5-star review. We love the 5-star reviews. Those helps us out a lot, so that would be great if you could do that. If you are a returning listener, awesome. I hope you are enjoying the beginning of your 2018. We're doing some awesome things here, and I'm glad you're here with us right here, right now. Make sure that you have subscribed on iTunes and also left us a review. That helps us out a lot, not with just, empowering our heads and making us feel all warm and fuzzy inside, but it also encourages us to get on the new and noteworthy section of iTunes. And that will also help us out with getting you additional shows. Without you, we cannot make this possible. So without further ado, I want to introduce you to a guy that is doing some amazing things as far as getting folks loans as real estate investors. And he's really making some things happen in his side of the world. And it's really something, we originally had this podcast interview scheduled a while ago, but we had some issues in December with my mother-in-law. She wasn't doing too good, and we had to reschedule. So thankfully, his schedule opened up and allowed us to get this rescheduled. So without further ado, I've got Tim Leber with Corvest with us. Tim, how you doing, buddy?
I'm doing well, Jason. Thanks for having me. I really appreciate it, and I'm looking forward to sharing a little bit about what we're doing and hopefully helping some of the listeners out there.
No, absolutely. I think with what you have, you're going to bring a ton of value to the table, and that's really what it's all about with us doing the No Flipping Excuses show, is really giving back a ton of value to brand new investors all the way on up to seasoned pros. And, just to let everyone know, some of the things that Tim and I discussed offline was, some of the products that he's offering, like loan products that he can do. And we're going to be talking about those here on the show. Tim really wanted to discuss their blanket loan program. For those of you that don't know what a blanket loan is, we'll get into full detail on that. Tim also has a great bridge loan product and also a 30-year program. So for those investors out there that really want to take advantage of some of the products that Corvest is offering, that's why we've got Tim on here right now. But Tim, why don't you, before we hop into those products that we discussed offline, why don't you tell us a little bit about what Corvest is?
Sure, and obviously, going over the three products on a high level, the bridge product, the term portfolio, and the single asset long-term rental loan, we can jump into a little bit later. But
Yeah.
high level, we are a direct lender in the residential income space, and our focus since our inception has really been revolving around being able to finance property owners of single families, condos, townhomes, and small multifamily, but not exclusively as one-off deals, really primarily as blanket mortgages over portfolios of these assets. Traditionally in the rental space, you would come across your conventional financing where you'd put a 30-year, fully amortizing mortgage over one property and then rinse and repeat. So what we've done is actually started a platform that allows you to cross-collateralize multiple properties under the same mortgage and structure it as a commercial note, which is a little bit different than what some of the first-time investors are used to finding in the market. Obviously over the years, we've grown to now do over $3 billion in loans in the space, and we are one of the largest players in this rental portfolio market. So, myself, I've been at this company since its inception, or close to its inception. I've seen it transition and grow over the past 5 years now. And looking forward here, moving into 2018, I think there's a lot of really exciting stuff happening in the space. And anything I can share with you guys and give you the inside scoop about what we're seeing and help you out, that's what I'm here to do.
Yeah, you know what? You bring up a really great topic, especially for the State of the Union for real estate in general, not just for real estate investors, but what are you kind of seeing as the State of the Union for real estate moving into 2018? Because we're still, we're about middle of the way through here in January. What do you think as far as what are you're foreseeing so far? What did you see in 2017 that might carry over into the new year? What does that look like from your standpoint?
Sure. I think there's obviously a number of different overarching themes that we see from the lender side of the table. And I think, in 2016, even going back all the way to 2016, we kind of saw a shift from, portfolios or one-off deals being readily available in markets, still at a steep discount, was starting to dry up a little bit. I mean, obviously, 2010, 2011, 2012, people were picking up properties, 50% under market, 40% under market, whatever it may have been. That's just not the case anymore. And I think 2017 was really the year where we saw the deals start to dry up a little bit in some of the more core markets.
Yeah.
I think for us, as we're transitioning into 2018, we're seeing a lot of new capital influx into the space. Some of our older, more active borrowers are absolutely still buying. But what we've seen is that they're starting to move into markets that are a little bit more of a secondary market or a little bit more of a tertiary market. And not just geography-wise. I think we've seen a big push, away from some of the even single-family into small multis, into the 2 to 10 unit space, where the yields can often be a little bit higher than just picking up a one-off single-family home.
Right.
So that's something that we're going to see more and more in the future here. Some of that smaller multifamily that might not necessarily qualify for any sort of agency mortgage through a Fannie or Freddie small balance. We're certainly going to see a lot more of that.
Okay. Yeah, I could definitely agree with you on seeing more capital being put into the marketplace, especially like real estate investors. Well, not even so much real estate investors. It could be somebody that's been stock trading for 30 years and they've built up some capital, and now they want to kind of switch it from being, the market right now is pretty volatile as far as like the stock market. Yeah, it's doing pretty well with the Dow doing what it's been doing, but there's always been that stability factor with real estate if you really do your due diligence the right way. And what I've been seeing too is more capital being infused into the marketplace right now. So I could absolutely agree with you on that one, Tim. All right, Tim. So what we're going to do coming up here in just a little bit is we're going to go over a little bit more of the State of the Union. We're going to cover some of the loan products that you have and how they could be beneficial for our listeners. And we want to make sure that people know exactly how to reach out to you here. So we're going to be covering a lot of aspects here. So folks, I will tell you this right now, make sure you stay in your seat because Tim and I are going to be going over some strategies here that you will not want to miss. These are strategies that are going to build up your wealth from a long-term standpoint. So stay tuned. We'll be right back.
Have you been struggling to close your first real estate deal? I hear this all the time. And you're not the only person in the not having closed your first deal boat. I was there and the feeling is horrible. I can tell you on page 103 of my book, Right Flipping Now, I address how you can easily overcome closing your first deal quickly and easily without using any of your own money or credit. My first deal closed when I was on vacation. I made $26,000. You can do the same thing. Grab a copy of my book at getmyflippingbook.com and you can get your first deal closed for massive profits. I have copies of my book available at getmyflippingbook.com and you can have a step-by-step plan for making profits on your first deal closing within the next 30 to 60 days. Go to getmyflippingbook.com. That's getmyflippingbook.com. www.getmyflippingbook.com.
All right, we are back and we are with Tim Leber with Corvest, and we just covered some of the awesome things that Tim's been seeing, I've been seeing as far as what's been going on in the real estate market, and a quick State of the Union for 2018. We've been seeing more capital being put into the real estate market here. We've been seeing individuals start going after smaller apartment buildings. And Tim gave us some insights on some of the things that he's been seeing too, as far as the apartment buildings, more capital being deployed into the marketplace. So Tim, what else would you say that you've been kind of seeing as far as, you know, the real estate market, things picking up in certain markets? Or what are you kind of seeing as, you know, a lot of investors moving forward to?
Sure. And I think a couple things kind of piggybacking off where we left off with the State of the Union is there's always something about the single family market in terms of investment, the single family investment space and that small multifamily investment space that's overlooked by a lot of the larger players in the traditional commercial real estate investment market. And we've really been able to capitalize on that opportunity. And I think the way that we've been able to add value in the market is by creating a commercial loan product that has the same structure as what you might find on an institutional quality multifamily property, but structuring it so that it can encumber these portfolios of residential homes. And that's been able, that's allowed our investors to ultimately have access to a competitive mortgage that you wouldn't traditionally, that you wouldn't traditionally find for single family product in the form of these portfolio loans.
Right.
Now, looking at this as our first product, I really want to go over ultimately how the size of the portfolio and the cash flow of the portfolio is ultimately going to affect the type of loan that you would qualify for. Now, at Corvest, our focus has been on being able to provide non-recourse financing, meaning that you aren't required to sign a personal guarantee on the mortgage, and being able to offer higher leverage debt. And what that means is we're able to lend up to 75% of the value of the portfolio level appraised value.
That's great.
Of the assets. So it's a little bit different in another sense from traditional single family mortgages, being that the deal itself isn't qualified on the borrower's personal income or even credit. Obviously, there's going to be certain credit requirements we need, over 650, 660 or so. But really what we're looking at is the net operating income on the properties.
Yep.
And the ability of that net operating income to support the principal and interest on the loan that you're ultimately trying to achieve at whatever leverage point that is. So it's a cash flow deal. It doesn't matter if you write off all of your income as a property owner. We can still get you an extremely competitive non-recourse mortgage over all of your assets.
No, that's great. And so you're doing 75% of the value, not after repair value, right?
That's correct, yes. Now, I mean, obviously on the bridge product, we can take a peek inside about how we would ultimately underwrite those deals, because we would look at after repair value in some of those cases. But for the portfolio product, this is for a stabilized loan. So these properties would have tenants in place. We would need to be at 90% occupancy at the portfolio level. And we would be looking at the as-is value. And when we get the deals into underwriting, we would ultimately appraise all of the properties individually in that portfolio to get to that portfolio level value.
Now, do you have a combined loan to value? Like, let's just say, I'm a new investor, or maybe, I've done a few deals and I find an apartment building. It's a 10 unit. It's at 95% occupancy. The leases are in place. They're everybody's got a minimum of 2 years left with their lease. Let's just say I come in, the capitalization rate's very strong. Everything's strong on the property. There's nothing that needs to be done on this actual property. Would you allow me in this particular example to come in and do like seller, let me get a seller financed note so that I could try and do some sort of a creative strategy so that I wouldn't have to put any of my own money out of pocket?
Unfortunately, we wouldn't be able to include any other position on the property. We would have to be the first and only position on these assets.
Okay.
This is for stabilized pools. So, at our minimums, as long as we're at 5 properties and 500,000 in loan size or greater, we can include however many properties you need to. What we can't include is any properties that would push that portfolio level occupancy below 90%. And we can't include any properties that require intensive rehab. That would be a different product on our end. That's where we would transition into trying to set up a line of credit for some bridge funding.
Okay. And yeah, we were talking about that a little bit offline. So with this particular loan product that you have, it also offers an opportunity for folks to build onto their portfolio. So let me give you this scenario, because some folks that may be listening right now, they may want to know this. So let's just say I have a portfolio, and I have about 40% owed roughly on each property, and right now I'm at like $1 million, and they're worth, let's say $2.2 million. I would be able to come in essentially, and I would pool those together and just get one loan. And at that point, I not only save a bunch of money by combining and doing one loan with you on your portfolio product, but I also can take out up to 70%, so I could have that additional cash deployed so I can go acquire more properties that I could add to the portfolio.
That's exactly right. I mean, that's the idea, is we don't want to limit you on the amount of cash out that you can pull out of these portfolios that you own. What I will say is, as long as you've owned the properties for over about a year on the average portfolio seasoning date, we can cash you out for really as much money as you can pull out of the portfolio. As long as we're above that 12-month seasoning period, there's really no limit, because the idea is that we want our borrowers to go out and buy more properties. We want to do everything we can to facilitate people going out, purchasing more assets, and ultimately financing them with us as well.
Yeah.
In a lot of cases, what we'll do is we'll cash people out of their existing portfolios, not only because they want to pull money out, but because maybe they're looking to transition to a true non-recourse loan where they don't need to sign a personal guarantee. Or maybe they're just looking for management efficiencies, even if the rate is somewhat comparable to what they have now, or maybe just slightly lower. We're still doing the deal, because from a management standpoint, it's easier to have one statement, one reserve account, everything with one servicer, rather than having 10, 15, 20 separate loans and different payment dates. So it certainly saves a lot there. But also, yes, the idea is that we're using that cash out as a qualifier to get them up and running with new property acquisitions.
No, that's great. That's great. And this, for folks that aren't realizing what this product does, is it essentially takes the example that I just did, and it almost allows you to double in size on your portfolio, which is a gigantic wealth builder. And with what Tim does over at Corvest is, say for instance, I had these deals spread out and I had private money loans on them. And this is kind of an example I would give, especially if you need 100% financing and you want to eventually take your portfolio to Tim to do these loans for you, is let's just say I'm at 8.5% on each one of my loans that I have for this portfolio that, is at $1 million and is right around $2 million in value. What Tim essentially is going to do is come in, do the portfolio loan, and you're going to be able to knock down that rate substantially, right? What if I had a 680 FICO score? Where would rates be for me?
Sure. And I think the most important thing about our loan products is that the credit score you're coming to the table with doesn't necessarily solely define where your rates are going to shake out. I always tell people that, if someone ends up coming to us with a 650 credit score and a couple $1,000 in the bank, they're going to end up getting the same rate as somebody that has an 800 credit score and $2 million in the bank, right, if they're coming to us with the same properties. Obviously, the goal for us is refining people out of these higher interest rate private money mortgages, that could creep up into 7, 8, 9% on some of these single family products.
Oh, yeah.
If it's a scattered site portfolio or whatnot, and we're able to refi them down into that 5%, 6% range for non-recourse debt. And ultimately, if you're shopping around in the market, you'll find that, being in that high 5s or low 6s for a 75% levered non-recourse portfolio is going to be extremely competitive. And I think tracking the market, seeing where rates are going, obviously we want to lock those in as soon as possible. I think everyone's seen interest rates starting to rise, but we're still locking people in that high 5s, low 6% range for debt.
Gotcha. No, yeah, that makes sense. And, this obviously really plays a huge factor in, of benefit for, the investor, because we get to pay off our private money and we get to pool all of the loans that we have out with that private lender. Because here's what's going to happen for folks that are listening. We pay off our private lender or private lenders on multiple loans that we have. Yeah, they're getting paid their money. That's probably better money than what they could be putting like in a stock market or money market account, whatever may be out there. Real estate, in my opinion, is always going to be a great path for anybody to build wealth. Either you're the investor or you're putting capital into deals. You get to pay those off, and then what happens is somebody like Tim comes along, helps you out with putting those loans together. So you go from paying 8.5% to high fives to low sixes, and you just have one loan now instead of like 10, 11, 12 on the scenario I was given, for that deal, the package that's worth $2 million and it's about $1 million in loans that you still have out. You're able to pool money out too, which is great, Tim. You could pull up to 70%. So you now have acquisition capital that you could put into new deals. Plus you also freed up some capital for your private lenders. So that's also going to help out too, because you can go to the private lenders now. You've got some of your own capital. Maybe you might put some capital into some deals. But the great thing about that is you now can almost double the size of your portfolio. And in the same turn, you season the new loans that you have, and you come back to Tim in a year, and he could do this all over again for you and package them all up. One other thing, but before we take a quick break, Tim, what's kind of like the rate on this type of a loan? Is it like a 30-year, 20-year? What are we talking on this one?
Sure, and yeah, I guess we didn't jump into that yet. I mean, these loans are going to be different, right? I mean, typically you're seeing a 15-year, maybe a 30-year fully amortizing for conventional mortgages or bank loans in the space, but our loans are going to be more commercially structured. We're going to be at a 5-year or a 10-year loan term that's amortized over 30 years. Now, okay, it's going to be a balloon payment at the end of that 5 or 10 years. So you do have to understand, as the clock's ticking down on that maturity date, that you do have an exit strategy. But ultimately, the idea is that we want to refi you. I mean, if we can, we want to, help capture whatever appreciation has come into play on the properties and refi you right back into a new 5 or 10-year mortgage.
Okay. No, that makes sense. And we'll talk about some additional strategies here coming up. I've got some things that you can do in order to, if you want to do a refinance or some of the other strategies that I have in order to get yourself in a position to where you don't have to wait, like Tim was talking about with the clock ticking on you on these balloons. You want to avoid, going up to the 24th hour and all of a sudden that loan becomes due in full. So we're going to talk about some awesome strategies here. Tim still has some products that he wants to talk about that are going to not just help you out right now, but also increase your wealth over a long period of time. So stay tuned. You do not want to miss this. We'll be right back.
I hear from real estate investors how much of a challenge it is finding motivated sellers. This is happening all over the country. Real estate investors not knowing where their next deal will come from. I can tell you on page 141 of my book, Right Flipping Now, I address how you can easily find deeply discounted off-market deals. The 98% of investors out there don't have a clue about this. You can easily duplicate this process within your own business today. Grab a copy of my book now at getmyflippingbook.com, and you can start finding deals for 50, 40, and 30 cents on the dollar without any competition. I have copies of my book available right now at getmyflippingbook.com, and you can have a step-by-step plan for making profits within the next 30 to 60 days. Go to getmyflippingbook.com. That's getmyflippingbook.com. It's www.getmyflippingbook.com.
Hey there, it's Jason Lucchesi with the No Flipping Excuses Show. Welcome back. We've got my good friend Tim Leber from Corvest, and we've been discussing some amazing stuff here. If you're just tuning in right now, I'd highly encourage after you listen to the rest of the show that you go back and listen to the rest, because we talked about some State of the Union stuff for 2018. We talked about some amazing loan products that Tim has for building your wealth in a dramatic way. And kind of what I want to talk about leading into how we ended the last part here is how we could really take advantage of a loan product that Tim has. Like, say for instance, we do have a package deal and we're able to put that into one portfolio product that Tim has. And Tim was mentioning that they have 5 to 10 year balloons, and they're amortized over 30 years. So what that essentially means is once that 5-year mark or 10-year mark comes up, your loan, whatever is on the remaining balance, is due. So if you don't refinance, if you don't sell your properties, you have to get out of it one way or another. Unless you have all of that capital to give and to pay off, it's going to be extremely difficult for you at that point in time. So we don't want to cause a problem like what happened in 2008 with all these adjustable rate mortgages coming due, and then all of a sudden rates jumped up for folks by 3%. They went from 6% to 8.5%, 9% by doing an adjustable rate mortgage. This isn't an adjustable rate mortgage, but still, if something happens and you can't refinance, the best play would more than likely to be, what did you do to improve the properties in order to do what's called a value play? What did you do in order to increase the value in a way to where you could sell the properties off and just be done with it and pay off the existing loans? The best thing that you could do is increase rents, increase the value of the property. And that will also, what that will do is increase capitalization rate, cash on cash returns, depending on what folks are wanting to do with their capital. But Tim, do you have anything on top of that before we hop into your next loan product that we want to discuss? Like what if somebody can't get a refinance and it's like they're at 4.5 years on a 5-year balloon?
Sure. I mean, look, typically in our world, we've been around long enough to see these loans come full cycle. And in almost every case, we're able to refi somebody out of their mortgage, their previous 5-year note at maturity. And that's usually through that value creation.
Yeah.
It could be through some capital expenditures you've done to the property. It could be through, like Jason was saying, increasing rents. But either way, we don't lever high enough, or we don't leverage the properties high enough where we would typically see an inability to refinance
Right.
At the end, because we're going up to 75%. We're not going to, 80, 85. We're just not going to put ourselves in that kind of risk exposure. And ultimately, look, if there's an inability to refi at the end of the mortgage, we do offer a bridge platform that would ultimately allow you to refi out, albeit at a shorter term, year-long position on the property. But I think it's a good transition to jump into our next product here, which is those acquisition lines of credit, or the bridge lines of credit, if you will.
Yeah, absolutely. Let's talk about it because, Tim, being in the mortgage business at probably, from 2002 until 2000, 2008, I saw a variety of different loan programs, from people with 580 FICO scores getting 100% financing. And I think that's what caused a lot of the problems that we saw from 2008 until 2011 with the foreclosure spike. But what you guys are doing, you have to also keep in mind here for folks that are listening, they're not, putting themselves in a position to where they are giving you 100% financing. They're putting themselves in a very, very smart position as far as they're not going higher than 75%, because that doesn't make sense. They would put themselves in extreme jeopardy and extreme risk. And I'm sure, being able to raise capital for their company would not be something in existence, because as an investor, you don't want to get involved with something that's extremely risky. You want to come in at the lowest possible point. So without further ado, let's talk about your bridge product that you have here, Tim, and let's discuss how that would be beneficial for someone.
Sure. And I think going along the overarching theme of building wealth and creating value and revenue streams outside of your traditional income, obviously real estate is the best play, and not everybody has the ability to go out there and purchase a 10, 15 property portfolio for, $1 million, $2 million, whatever it may be. Obviously, we work with investors at that level, and we work with investors that are able to take down a $50 million portfolio in one fell swoop, which is obviously the large balance space. But we're a group that's going to cater to every level of investment, from somebody buying their first couple of properties all the way up to that more institutional quality investor. And what we've done and what we've created is a bridge line of credit, or an acquisition line of credit, for anyone from people starting out to people that are on their 50th rental property. It doesn't matter. We're setting up these credit lines for people to go out and acquire several properties over a year period. Now, I'm sure a lot of the listeners have obviously seen some sort of bridge lender in the space, and a bridge loan is really a short-term loan, not based on any income in the properties, for example, or it's not exclusively for stabilized assets. But there's a lot of bridge money in the space. But what makes our loans different is we're able to qualify an investor based on their truly liquid assets. If they're able to show a certain amount of liquidity, then we can set them up with access to a $1 million credit line, a $2 million credit line, a $10 million credit line, whatever it may be, for them to go out and draw on for a 12-month period. So let's just use an example where somebody has a plan. Let's just say you're a newer investor. You're going to go out and you're going to buy 5 properties over the next 12 months. You know it's your plan. You've saved up some money. You've got a couple $100,000 in a fund that you put together with yourself or your partners that you want to go out and deploy. You would come to us not on the first acquisition, but rather you would come to us to set up the credit facility itself, and we will qualify you. Obviously, there's some minimum credit requirements we talked about, that 640, 650 FICO. We need to see 20% liquidity or net worth to get the line, compared to that full $1 million. But once we set you up with the credit facility, you're off and running. You're able to take down properties at essentially 20% of what that purchase price would be, because we would be advancing the other 80%. Now, these loans are going to be due in 12 months. So it's important to understand what the disposition will be. How will you pay the lender back? But for us, as long as we're comfortable with your borrower profile and your business plan, we're setting you up and you're off and running, funding these properties. Every time you find one, you're funding in 7 to 10 days. So it's an extremely quick funding. It's gives you the ability to pull the trigger out there when you find deals, because obviously the good deals aren't going to sit on the market for long.
Right. Exactly. Yeah, you need to pull the trigger, especially in today's market. Wouldn't you agree?
Exactly. I mean, that was kind of going into the theme a little bit earlier, discussing the state of the market. Is there's just so many investors and such a capital influx into the market right now, that we've seen some groups go into areas that are out of state, for example. I mean, half of our borrowers aren't even investing where they live. Obviously, you have the infrastructure where you are. You're able to go out and survey properties yourself, but we have borrowers buying, across state lines. There's really no geographical focus that we can't handle, or structure that we can't handle. So it just gives investors some flexibility to go out and where they can find higher returns rather than being confined to one state or one market.
No, that's true, because here in Indy, it's crazy. We've got crazy in a good way. We've got folks from Hawaii, California, people out of the country that are wanting to buy here in the Midwest. They're wanting to buy in Michigan, Indiana, Ohio, some parts of Wisconsin, Illinois, Kentucky. They're wanting to buy here just because they could purchase properties so cheap, and they cash flow, at a substantial rate. So we've got folks, and I could attest to, a lot of folks don't really invest, especially the ones that have capital that they want to deploy into properties. They're not necessarily all going to be in their own state, because it's got to make sense, because you could essentially buy 10 properties here in Indiana that it would maybe cost to get one property in California, depending on the location. So it's got to make sense too, in order for that to work. So hopefully that makes sense for folks. The bridge loan is great. So you can get approved. You said 7 to 10 days is the approval process for getting a bridge loan, and obviously you've got to have the liquidity Do you guys require that liquidity to be in any type of a location, like a self-directed IRA, savings account, bank account? What do you guys have a recommendation?
Yeah, we don't really have anything specifically it needs to go into, and that's the beauty of it, is that we're not requiring any sort of movement into a lender-controlled account or something. We're just looking at a snapshot in time of obviously bank accounts, easily marketable securities. Typically, we would not use an IRA or a 401k or something that's a retirement account as liquidity. But what we do use, and especially for some of the more active groups out there, obviously a lot of our investors, as soon as they have capital liquidity come in, they're going to deploy it again. So they're usually cash poor at the time. But if they're an active fix and flip investor and they have properties on the market for sale, we would include those as a near-term liquidity event, and we could ultimately qualify them that way. If they had, a couple $100,000 worth of properties that were under contract to be purchased that were flips or something, that would absolutely qualify as well.
That's
the process itself is really let's call it a 30-day setup. Usually on the quick end, it might be 21 days. On the longer end, it would be 28 days, where we would be underwriting the borrower. Okay. This is just to set up the credit line. So I don't want anyone to think that it's going to take them that long to fund on each individual property. But once we set up the actual credit facility itself, that's when you're off and running. Every time you find a property, you're submitting a bid or entering into a purchase contract, you're picking up the phone and you're calling the funding team, and they're getting on it. All we need is a BPO, a broker price opinion, and and the title work done quickly, and we can fund these in ultimately 7 to 10 days is our indication. So the actual funding process themselves are going to be quick after we get the initial underwrite of the line.
It's a pretty quick underwriting turnaround time, because a BPO, that wouldn't take long. That might take less than a day. The only thing is that might take a little bit of time depending on the county of where you are across the country. That could take anywhere from 2 to 4 days. So the turnaround process is really, really good. That's not bad at all, especially in today's market when you need to move pretty quickly. So that also go ahead.
Yeah, sorry, just to touch on that part real quick. I don't want people to think that, there's certain markets and certain auction processes. Obviously, you got to come with cash, you got to fund same day. And obviously, we couldn't necessarily accommodate a same day funding. What we could do, though, is the bridge product. I don't want to pigeonhole it exclusively into an acquisition facility where it's used for the purchase financing, but we could also refi people out of properties that they currently own. So if they have to fund all cash day one, we can come back to them in 10 days or whatever it may be. Once they have control of the properties and they have title to the property, then we would refi them out of that using the credit facility, where we'd be able to finance that lesser of 80% of cost or 70% of value on the refi.
That makes sense. Yeah, that makes perfect sense. No, that's awesome. So here's what we're going to do. We're coming up here is we're going to go over some of the top tips from Tim and Corvest and how we could really help you out and make 2018 your best year ever in real estate. So stay tuned. You do not want to miss what we have coming up here. Talk to you in a second.
Are you facing a roadblock with getting started in real estate? This is an obstacle a lot of brand new investors face. Building a rock-solid foundation is key to building your investing empire. I can tell you on page 95 of my book, Right Flipping Now, I address how you can build a lasting foundation that won't topple over when you're on the third floor. Do not avoid laying the proper foundation for your business. I've made this drop dead simple for you to just rip off and use within your own real estate investing business. Grab a copy of my book now at getmyflippingbook.com, and you can have the confidence you need to find and flip deals consistently month after month. I have copies of my book available at getmyflippingbook.com, and you can have a step-by-step proven plan for making profits on your very first deal, or maybe that second deal, closing within the next 30 to 60 days. Go to getmyflippingbook.com. getmyflippingbook.com.
Hey there, it's Jason Lucchesi, and welcome back to the No Flipping Excuses show. I'm joined with my good friend Tim Leber with Corvest, and we've been discussing some amazing opportunities that you could be taking advantage of right here, right now in your real estate investing business. If you just chimed into what we've been discussing, I would encourage you to definitely listen to this episode from start to finish, because we went over the State of the Union. We went over some great strategies if you are wanting to build up long-term wealth. We also have some ways for you to work with Corvest to get what's called a credit facility so that you could start doing loans without having to worry about raising private capital. Although I love raising private capital, this will get you deals closed in 7 to 10 days with Tim's bridge loan, which means you get a credit facility. It's not a long-term loan. It's a 1-year loan. And we've been discussing that. And we're going to discuss one other product that Tim has. And then Tim's got a really good tip for us. It's a high-level tip that we want you to use. So Tim, let's talk about this 30-year program that you have and how folks can take advantage of that.
Sure. And this really rounds out the product offerings that Corvest brings to the table. And, obviously there's variations of our various products, especially the bridge product, that certainly I can leave my contact info at the end of this podcast and you can get in touch directly on. But what I did want to touch on before we jumped here into some more high level overviews is really the single asset product, the 30-year fully amortizing mortgage that we offer for investors that may only own 1 or 2 properties. Now, there's certainly the opportunity in the market to go after conventional financing for rental products or for rental properties, such as a Fannie or Freddie mortgage, some government-sponsored mortgage. But those are going to require you to have a certain income. You got to meet some DTI standards. It's just not going to be strictly cash flow based. So we've developed a single asset product that's going to ultimately allow you to get up to that 75% leverage point and be able to base it solely on the income of the properties. Now, credit score does come into play a little bit more on this, which will ultimately help affect how your rate will be derived. But you can show theoretically zero income. So for investors that have either maxed out the number of agency mortgages they can get on their individual rental properties, or perhaps there's, their DTI is going to be too high to qualify for another agency or conventional mortgage. This is a great product because it's ultimately going to allow you to strictly base it on the cash flow.
Oh, that's great. That's great. And as we know, cash flow is what really separates you from somebody in the business that's just, wholesaling or rehabbing properties. If you don't have that cash flow coming in every single month, it's kind of like almost you're having a tidal wave that you're trying to ride. And as we know, it's up and down, up and down. So, using a company like Tim with Corvest, this is going to help you create that wealth, that cash flow that you want. And that leads us into Tim sharing a tip here that's going to be able to really set you apart and really give you, some additional strategies that you can use for your business. So Tim, without further ado, I hate to put you in the hot seat, but what's your top tip that you'd love to share?
Sure. And I think it's not something that's so secretive, but sometimes it git's overlooked. And it piggybacking on what we were talking about a little earlier about investing out of market, I'm going to take it a step further. And I would say, not only don't be afraid to go out of the market that you're in, but don't be afraid to drop down to a price point that you might not necessarily think would create an effective return on a property. So some of our largest borrowers in California, for example, are going into markets where, out here you got properties for 300, 400, 500,000. That's typically middle of the road for out here. What they've done is been able to sell some of those higher value assets and start investing in markets that you can buy properties for $50,000, $60,000, $70,000. So in effect, they're trading out of their higher value assets, usually through some sort of 1031 or like exchange, into 5, 6, 7 properties in one fell swoop. So it's allowing you to help capitalize and rev up your acquisition strategy. It's like steroids ultimately coming into your capital infusion here. So that's my biggest tip: is don't be afraid to invest in the lower value assets, because those are either the markets or the price points that are going to allow you to put in the least amount of rehab on those properties comparative to the actual asset value, and get the highest rate of return on those cash on cash returns if you can leverage right on those assets. So that's what I'll leave you with, high level. Don't be afraid to go out of market, and don't be afraid to trade into something that might be a little bit less in terms of property value, but at the same time, it can help you ramp up the acquisition of more properties and have your capital go farther.
Absolutely. No, that's important. And, we tend to do that as well with our business. So it's always a great reminder, especially from somebody that is constantly working with investors and doing loans for investors. This is always great feedback to hear from somebody like Tim that works for a company that's, doing the amount of volume that they're doing. Tim, what's a really great way for folks to be able to reach out to you?
Sure. And I can leave my email address. And if you want to scope out, obviously, more information on our company, you can go to www.corvestfinance.com, poke around on there. But if you have any questions directly as to our loan products, or if you have a specific loan scenario, the best way to reach out to me is through my direct line, which I can leave with Jason as well. But that's going to be 949-344-7889. That's going to be the best way to get in touch with me. If you can't reach me there, email is always good. It's Timothy@cvest.com, and that's TIMOTHY at C as in Charlie, C the letter C, Vest, VEST.com.
No, that's awesome. Thanks for joining us, Tim. For those that want to check out some of the loan products that Tim has, make sure you do send him an email. He's really fast with responding. Him and I have been corresponding now for a while. Again, it's Timothy@cvest.com. And we also want to make sure that for folks that are wanting to come to our upcoming No Flipping Excuses Summit, it is going to be March 9th through the 11th. And right now you could get enrolled. We have the seat deposit, which is just $97, that allows you to come to the event. So you can check it out by going to Join NFE. That's JOINNFE.com. So make sure you go check that out. Again, the dates are March 9th through the 11th in Las Vegas. Come and join us. We're going to be doing live negotiation calls. We're going to be getting deals under contract. And some of the keys that we're going to be doing here is getting you in a spot to where you can use Tim's services, to where you could build up that long-term wealth and have that cash flow coming in every single month. So again, join us. It's at joinnfe.com. But other than that, if you have any questions, anything that you need whatsoever, you could feel free to give us a call at 317-900-1307, or you could reach out to us. Our support email is support@jasonluchesi.com, and that's spelled JASONLUCCHESI.com. Thanks for your time. Hey, Tim, thanks again for joining us, my man. This was a really, really great show, and I appreciate you being a guest on here.
And I appreciate you having me. Thanks a lot, Jason.
No problem. Enjoy your day, and we'll see you on the next episode. Bye now.
Thanks for listening. For show notes and links to anything discussed on today's program, visit noflippingexcuses.com. If you'd like to call the show, dial 317-900-1307, 24/7. Leave a message with your first name and where you're calling from, and include your question, comment, or concern. Who knows? You might end up on the air with Jason Lucchesi. If you like the show, be sure to subscribe on iTunes or Stitcher. The links are posted at noflippingexcuses.com. Remember, you can close more deals now, make your own rules, and design and live an amazing life without having some jerk-off boss tell you what to do. Share noflippingexcuses.com with like-minded people you know who are ready for badassery, crushing it in real estate, and enjoying freedom to whatever you like, whenever you like it.